All right. So we're going to look at the second question that we marked. I've looked at it. Two questions are not enough. What can we possibly do? Um, so I am looking at giving you maybe additional 2 or 3 questions that are especially strictly what is it called? Strictly consolidation. And then I ask you to do that on your own. And then you get back to me with your solutions. And that way we can, ensure that the whole class is practicing more questions. All right. Um, because like I said, we are not too far away. We can within the time frame that we have left, yeah, I'm sure we can complete the rest of the syllabus. But there won't be enough time for me to keep going back to um to solving more questions around what we have done. All right. Okay. I just wanted something that had to do with
Right, sir. Good
foreign.
afternoon, sir.
Good afternoon, Mr. Olusoji.
Please,
Good
which
afternoon.
question is this case?
I shared this one with us. Let me see. This was May 2024.
Okay.
May 2024, question 1. I already shared it with you. Let me just highlight it there. All right. If I have everybody's attention, then let's move on. The question requires us to. So I like to first of all go to the requirements, like I always say. The requirement is that as the financial controller of Calabar Nigeria PLC, you have to draft a report addressed to the finance director of your company explaining any adjustment which needs to be made to ensure that the subsidiary companies, Mansa Cocos Limited's financial statement comply with IFRS requirements, meaning that we're going to be dealing with standards for the first requirement. The second requirement now, prepare a revised statement of financial position for Mansa Cocoa Limited that will be suitable for consolidation with the parent's financial statement as at September 30th, 2023 in accordance with IFRS. Say note, show all workings, okay? And that's how we have a total of 30 marks. So that's section A for you, compulsory question, 30 marks. All right, now let's go back to the question in itself. Let's see what happened there. 2 requirements. The first requirement is saying we should make some necessary adjustments. All right. So it means you need technical skill with regards to standards. Very important. I'm even going to advise you for your exam corporate reporting, you would require your knowledge of standards have to be top notch. Top. It has to be top notch. Because even when you'll be given consolidation to do or things like that, I see a situation whereby they may decide to throw in 1 or 2, questions that have to do with, or maybe adjustment you have to make in line with IFRS. So very important. Let's go into the question, not to waste time. Calabar Nigeria PLC, a company located in Ajao Industrial Estate, Lagos. The company specializes in production of Adire t-shirts. Now, the company has a number of subsidiaries located in South and Southwest region of the country and overseas. On October 1st, 2022, Calabar PLC acquired 100% of the ordinary shares of Mansa Conco Limited an Nigerian t-shirt distribution company based in the Gambia, West Africa. The official national currency of the Gambia is known as Gambia Dalasi, GMD, right? Okay. What jumps out immediately here is we have a situation where there is a foreign subsidiary right here. Already know from here, there's foreign subsidiary. All right. Okay. The draft statement of financial position of Massa Cocoa Limited prepared under Gambia GAAP. GAAP, of course, is General Accepted Accounting Principles. As at September 30th, 2023 is as follows. So the first thing that jumps out here again is that it's not just the fact that this was presented, this financial statement has been presented in what you will call the functional currency as opposed to the presentation currency of the parent. Now, the parent, mind you, you have been told is a Nigerian company, right? So therefore, expectedly, when they are going to do consolidation, you would expect that the consolidation will be done in Naira. So therefore, like we learned under foreign subsidiary, with the guidance of IAS 21 as well, what you do in this case is that you will translate the numbers you have here in GMD. You're going to translate them to Naira for you to be able to consolidate. Now, the second requirement makes sense to me now, because the second requirement says you should present this same financial statement in a way that it is suitable for consolidation. So you're not exactly doing consolidation. However, you're supposed to translate these numbers such that what is left to be done is just to consolidate the numbers with that of Calabar PLC. All right. Now, so that's the first thing you see there. It was in the functional currency, which means the currency that was used in Gambia where this foreign operation is taking place. Another thing that immediately should jump out to you is with regards to this. You were told Gambia GAAP. It means they did not produce this statement using IFRS. And now this is usually the case. In my company, for instance, I think they sent someone from, I was speaking to the internal control officer who was sent down to Nigeria for some onboarding processes. And I was part of the people who he was supposed to meet with. And there I discovered that in Cameroon, they have their own gap. I can not just, it's not for Cameroon. I think it's for countries like Cameroon, Cote d'Ivoire. I mentioned a number of those countries. So that is what they adopt. However, because they are a foreign subsidiary to a group of companies that are guided by IFRS, so they have to produce an IFRS compliant financial statement. So you will find this in practice one way or the other whenever you're part of a group, when you work with a company that is a group of companies. So you might have a foreign subsidiary where IFRS is not what is used in preparing financial statements. It means you're going to have two sets of financial statements, the one that is compliant with the local GAAP and the one that is compliant with IFRS. All right, let's move on. Okay, additional information, that is where most of the interesting stuff usually would lie. They said the following are the key transactions of Mansa Konko Limited under Gambia Gap. All right. There is no deferred tax under the Gambia Gap. All right. First one, equipment. We're told on January 1, 2023, Mansa Cocoa Limited acquired some specialist equipment from the United States of America USA for $150 million. Payment for the equipment was made on March 31st, 2023. Now, something should jump out to you immediately you read this. The day the acquisition was done of this equipment was 1st January 2023, but payment was done March 31st, 2023, meaning that we are likely going to have two different spot rates. The rate at which, the historical rate at which we would have recorded, or we should have recorded this acquisition, and then you most likely will have a different rate on the day you are making payment. And now this is going to give rise to a realized exchange gain or losses. But let's look at what was done in the books of Mansa Konko. Okay, they said in accordance with the local Gambia Gap, the cost of the equipment was recognized on January 1, 2023 at 50 million GMD using the opening rate of exchange at October 1, 2022. So what happened here? What is IFRS position? IS 21 says you should record this transaction using the rate, the spot rate on the day that the acquisition of that of the purchase or the acquisition of that PPE. Now, PPE in itself, you must understand that PPE in itself is not a monetary item. We are not expecting to still receive any payment or whatsoever. So what that means is that I'm going to record this equipment at the spot rate, and I'll keep it at that spot rate. What does that mean? If I record it at 50 naira per dollar, for instance, I'll keep it at that 50 naira per dollar. That is it. However, it does not mean that I am not going to recognize an exchange gain or loss when I am making payment. So we're going to deal with that. We're going to have to do, just bear in mind, we're going to deal with that. What they have said is that it is the opening rate of exchange for the financial account year that you will use to record this transaction under the Gambia Gap. This is not coherent with IFRS. So this is one of the first adjustments you're going to first of all have to make. And how do you make that adjustment? They said they use opening rate. No, we can't do that. You're going to go and look for the January 1, 2023 rate, pick that, use it to recognize the PPE, and then when payment was made, you recognize the exchange gain or loss. All right, okay. Now, full year depreciation of 5 million was charged to cost of sale as Mansa Konko Limited depreciates the equipment over a 10-year life and it has no residual value. Hence, the equipment was included in the statement of financial position of Mansa Konko Limited at 45 million. All right, okay. Now, this is not exactly wrong. The only thing is that you have done your depreciation, most likely, they said for 10 years, you must have done that using this cost here, this translated cost here. And now this translated cost that gave you 50 million, we said the rate you used is most likely wrong. So therefore, this amount is also most likely wrong. Definitely, the depreciation you calculated is definitely wrong. Then we'll have to make an adjustment on depreciation as well. All right. Then we're also told the sum of 12.5 million GMD has been debited to retained earnings. This is in respect of the difference between the amount paid to the supplier of 62.5 million on March 31st, 2023, and the cost recorded in non-current assets of GMD 50 million. All right. So it's this 50 million that they must have done comparison with when they paid the actual conversion was 62.5 million. All right. The actual conversion was 62.5 million, but what they had recorded was 50 million. So they calculated the exchange difference. This in itself is not, the calculation itself is not wrong. What is wrong is the earlier amount that you must have recognized that we need to de-recognize now. Okay, we're going to get there. Impairment, sorry. Impairment, all right. Mansa Cocoa Limited bought a warehouse on 1st October 2016 for 180 million GMD. The warehouse is being depreciated over 20 years with no residual value. Okay, what jumps out to me here is your depreciation annual is going to be 9 million every year, 9 million GMD every year. All right, but we're told on October 1st, 2022, due to a rise in property prices, the warehouse was revalued to 210 million GMD, and the revaluation surplus of 84 million was recognized. We're going to go into the analysis of whether this is a correct amount, but we can even easily do that. Okay. I'm thinking if what you have here is 180 million, 180 million over 20 years should equals 9 million every year. All right. Now, between October 1st, 2016 and October 1st, 2022, we're going to count, we'll count the whole of 2016 down to October 1. Let me do like this. October 1, 2016, we'll count to September 30th. September 30th, 2017. And now that will represent 1 year, all right? Now, if we keep going like that, September 2018, that's 2 years. September 2019, that's 3 years. September 2020, that's 4 years. 2021, that's 5 years. 2022, that makes it 6 years, all right? So it means that your full depreciation, the accumulated depreciation over that period should be 9 times 6, all right? And that will amount to 9 times 6 should amount to 54 million. So what we do here is say, if I have 180 million and I deduct 54, if you do that with your calculator, 180 minus 54, you have 126, okay? 126 million. Now, if you have 126 million and the new value, the revaluation says this property now worth 210 million. So I can say 210 minus this 126 million. I think that's how they go, 84 million. Okay, so they are spot on with the calculation, no problem. Okay, now we're told that, let's come back to the question. They said on October 1st, 2022, due to a rise in property prices, warehouse was revalued to GMD 210 million and the revaluation surplus of 84 million GMD was recognized. Now, no transfer are made between the revaluation surplus and retained earnings under Gambia GAAP in respect of depreciation. All right. I'm going to come. Okay, let me just quickly say it now. let me ask, how many of us are conversant? We should be anyway. How many of us are conversant with revaluation method? Because that's under IAS 16, revaluation method. Do we still remember evaluation method? Now, there's a very tiny bit, what do I call it now? Whenever you do a revaluation, the excess depreciation, you can make a transfer. IFRS allows it under IAS 16. It says under revaluation method, when you have a revaluation gain, whenever there is a revaluation gain, there is going to be increase in the depreciation. All right. For instance, 9 million is the annual depreciation. All right. Initially, now that the asset is 210 million, but how many years left? There are how many years left? We have taken 6 out of 20. The useful life of the asset is 20 years, and we've done 6 years. We counted from 2016 to October 1st, 2022, 6 years. So it means we have 14 years left. If you do 210 divided by 14, you get 15, meaning that the new depreciable life of this asset, the new annual depreciation of this asset is now 50 million. Initially, it used to be 9. You see, this 6 million extra depreciation, IAS 16 allows you to transfer it out of the revaluation surplus. You debit revaluation surplus, and then you credit retained earnings. IFRS allows that. But they are saying there are no transfers that are made between evaluation surplus. That is, Gambia GAAP does not allow that. Is this clear, everybody? Before I move on. So, because this one is also a matter of awareness. Our IAS 16 give us this free will. A company is allowed to. You can do it. If you want to, if you choose to, you can. How many of us understand what I've just explained now? Do we get it?
It's not clear to me.
What did you say?
Please, can you take it again, sir? It's not clear to me.
Okay. All right. So this is what I'm saying. Look at the clause they have there. They said, what they said is this. They said, no transfers. No transfers are made between the revaluation surplus and retained earnings under Gambia GAAP in respect of depreciation. I'm now saying what should jump out to you here is that Mansa Cocoa Limited uses revaluation method in the measurement of their PPE. They use revaluation method. Now, when you use revaluation method, every time you revalue your PPE, what do? If there is a gain, according to IAS 16, IAS 16 says if there is a gain, what you should do is you increase the value of that gain to your PPE, debit PPE, and then you credit revaluation reserve. Abi? You credit your revaluation surplus or revaluation reserve. All right, is this clear? This should be clear. Okay, good. Now, the standard now went ahead to say, if you are free to do this, to say, okay, anytime there is a revaluation gain, what it means definitely is that your new depreciation amount, you know, when you are, was it this class I was mentioning it, that you don't do retrospective change when you are dealing with depreciation. What do? You do prospective into the future, right? So now that you have revalued your assets, you are going to calculate a new depreciation annual, right? And your annual depreciation is also going to now increase. You know why? The value of the asset has increased. The useful life has reduced. I don't know if you understand what I'm saying. When you calculated 9 million here, you did 180 million divided by 20. Now you have revalued up the value of the asset, and the number of useful life is no longer 20, it's now 14. As a matter of fact, we calculated it here, and we saw that the new annual depreciation is now 15 million. Now listen to what I want to say here. IAS 16 allows you, when you are doing revaluation method, to say that excess depreciation, that is 15 million, which is the new depreciation, minus 9 million, which is the initial depreciation. IAS 16 allows you to say, I am going to debit revaluation reserve, and I'm going to credit retained earnings. This is the transfer. This is the transfer that we were speaking of here, where I highlighted, where they say no transfers are made between evaluation surplus and retained earnings with respect to depreciation under Gambia GAAP. This is what they are referring to, that this is not doable. Now, it aims you to remember that under IAS 16, it is doable. Now, IAS 16 went further to say, if you have a revaluation loss, what you should do is, if you have recognized revaluation gains before, first of all, go and debit that revaluation reserve by the much that you have gains. Meaning that if I had a gain, of 84 million here, the first thing I would do, if I have a loss that is more than 84 million, I will go to revaluation reserve. I will debit the 84 million. Whatever is left, I will now take it to P or L. 84 million. And then all of that amount, I say 84 million, the balance, let's say the balance is 6 million. I'll take that 6 million to POL, then I'll now credit my PPE again with the whole of the 90 million. Is this clear now?
Yes, it is.
So I want to believe we remember this one more, but this other one I mentioned here, these transfers between evaluation reserve and retained earnings, not very common, hardly ever tested, because it's optional. It's left to the company to decide. All right, so we'll look at that when we get there. All right, they said, however, let's move on. We're told, however, there's been a slump in the local property market in Gambia recently. So an impairment review was undertaken at September 30, 2023, and the warehouse was assessed as being worth 60 million. All right, something that used to be worth 210 million is now worth 60 million. Therefore, a charge of 90 million was made to profit or loss to reflect the difference between the carrying amount of the warehouse of GMD 150 million before September 30th and the new value of GMD 60 million. GMD 60 million. All right. Okay, 210 million initially. All right. And now it has gone down to 60 million. In between them, there is definitely a difference of 150 million. All right. So I do not have a problem with this. We'll come back to look at it. Let's quickly go through the rest so that we don't waste too much time. We've already spent about 30 minutes. Now, financial instrument on April 1, 2023, Mansa Cocoa Limited bought 5 million shares in a local quoted company for 7.7 GMD per share. This represents a 3% shareholding. Now, what should jump to you immediately here is that this is for accretion of wealth. All right. I am going to be guided by IFRS 9 here. I'm going to be guided by IFRS 9. So what is left for me to find out now will be, what do they do when they buy shares? Do they do fair value through POL, or do they do fair value through OCI? All right. Now, they said the intention of the company is to hold the shares until December 31st, 2023, and then sell them for a profit. The shares have been recognized at a cost in the statement of financial position in accordance with Gambia GAAP. The market value of the shares as September 30th, 2023 was 12.5 GMD per share. Okay, we will not recognize that cost. What we'll do is this. The intention of the company already is telling you what is the business model. And what is the business model for them? They want to sell, they want to trade those shares. They have a particular day that they are going to trade those shares. So therefore, what should they do? They should fair value that equity instrument and recognize any movement, whether it is a gain or a loss, in their profit or loss. This is very much in line with IFRS 9. But what is in Gambia GAAP? They recognized it at cost, meaning that they are still recognizing it at 5 million multiplied by 7.7. All right, we're going to look at the difference, okay? And then we'll do it. They said under Gambia tax rule, income tax is charged at 20% on accounting profits recognized on the sale of investment. Now, this one does not concern us. We're doing consolidation here. All right. There has been no sale yet. Okay. So we're going to move on from there. Provisions. On October 1st, 2022, Mansa Konko Limited signed an agreement with the Gambian government for exclusive rights. Exclusive rights. Because I see exclusive rights, what should jump at me is this an intangible asset? I know I should be looking towards the provisions of IAS 38. All right, let's move on. For the next 20 years to supply Adire t-shirts for Gambia's National Traditional Festival, GNTF. Now, the cost of buying these rights was 42.5 million GMD, which had been recognized as an intangible asset. I'm sorry. In Mansa Konko Limited statement of financial position. All right. This is what they paid to get the rights. The right has a useful life of 20 years. So does this right meet the definition of an asset? Okay. It has they have control. They have control over that right. Why? Because they have paid now and the right has been given to them. Also, this was a transaction. This transaction was for this right. So we can see that in a separate transaction, with that, I'm talking about monetary item now. Is it a monetary item? Is it identifiable? Those are the conditions for you to capitalize, Abi. And now we can see that this right qualifies. How? You have paid a sum to get that right. Number one, you expect that you're going to be able to have economic benefit as a result of this right that you have now. Why? Because you are going to make t-shirts and you are going to be able to sell. Now, you won't be able to do that if you are not given that right. Okay? So that means that that right will flow to you economic benefits. All right. You're also, the issue of measurement is not a problem. All right. You are able to measure what is the cost, and that is what you paid for it, 42.5 million. All of this story tells me that what they have done is very much in line with IFRS. All right, there's no disagreement here. So I move on. I said, under the terms of the right of agreements, Masa Coco has to replace all damaged. Okay, it's getting interesting now. All damaged t-shirts at the end of 20-year period. All right, so they have to make a provision. Let's see. There is 40% probability that the eventual cost of replacement of the damaged t-shirt would be 75 million GMD, and a 60% probability of the cost of replacement being 50 million GMD. Okay, I have a 40% probability that the amount will be 75. I have a 60% probability that the cost of replacement will be 50 million. All right. Now, if I add up these two probabilities, it gives me one. It gives me 100%, meaning that all the possibility here has been covered. If I have not even done any other thing at this level, I believe you have done PM. So the expected value principle is what you are going to use here. I'll do 40% of 75, and I'll do 60% of 50. Whatever I get, I'll add it together. That should be the provision that I'm going to make. Okay. Now, what did they say happened? They said, however, for prudence's sake, a provision of 75 million GMD was made in the financial statement and debited to the operating costs. Even this debited to the operating costs. Now, what you should do in this instance, speaking to IAS 37, okay, 75 million, doing 75 million, why you will not want to do 75 million is, by how much is it probable that it is going to be 75 million you're going to pay? Is just 40%. Just 40%. However, you even have the probability that it could be 50 million by 60%. Now, the two scenarios that they are giving you totals 100%, meaning that you could calculate an expected value that is going to be the weighted average cost. All right, so you should do that calculation. Don't say because of prudency you want to do 75 million. Number one. Number two is that whatever provision you are making should be capitalized as part of the cost of the asset. It should be capitalized. You recognize the provision and then you capitalize that amount as well. All right. Masa Coco Limited has a pre-tax discount rate. Okay. There's a discount rate here. Okay, good. A discount rate. What do we normally do with discount rate? We use it to discount to the present day value. Now, that should bring to your mind the fact that these monies that they are referring to, they said this replacement will happen at the end of the 20-year period. At the end of the 20th year. So these monies are not present values. So it means they have given me an hint. Maybe I would not have thought about it, but the fact that they have now mentioned it is what has awakened me to say, okay, that 75 million, that 50 million, all this money they are mentioning, they are costs that we are expected to incur at the end of the 20th year. So what should I do? I should discount to the present value. All right. They said the replacement cost will be allowed for tax purposes when paid. Okay. The relevant income tax rate is expected to remain at 20%. Right. Okay. The exchange rate, we have exchange rate for October 1st, 2022, which is the opening rate for this year. All right. This year ended September 30th, 2023. We are as well given that closing rate, and then we have spot rate for January 1st, 2023, and then the spot rate for March 31st, 2023. I believe you already know in your mind what you're going to do with that. That is in reference to the equipment that we discussed earlier. Now they said, note, in Gambia, the tax treatment of PPE and exchange differences is the same as we have under IFRS treatment. Okay, meaning that we are not going to have any issues with tax treatment in terms of IFRS and Gambia GAAP. Okay, good. Now you were told that the following are the exchange rates between Gambia Galassi and Nigerian Naira. Okay, the exchange rate we had before was between dollars and Gambia, what did they call it again? Dalasi. All right, okay. We're giving the average rate for the year, the opening rate October 1st, 2022, and the closing rate September 30th, 2023. So I'm back to requirement number 1. As the financial controller of Calabar Nigeria PLC, draft a report addressed to the finance director of your company, explaining any adjustment which needs to be made to ensure that the subsidiary company's financial statements comply with IFRS requirements. All right. Okay. 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 Let's do it like this. I want to believe, first of all, you already know by now, you should know by now, whether it's your first time or it's your second time or whatsoever. You should know by now that most of your question answering, I want to believe when I wrote professional level, it was one of the things that I prepared solidly for. One of the things I prepared solidly for was the fact that my answers, some questions will require me to write something like a letter or like an internal memo. All right. Okay. So now the internal memo you want to write as a financial controller should not be a problem. I am more focused on what you are going to do. However, I want us to just see the look like. I'm not ready to do any teaching on that one. You are doing case study, I want to believe. So internal memo, some of us are even professionals already. I don't think that should be a problem. So you see how we went, the date from the financial controller. Who are you writing to? The finance director. You can be very creative with this one. This one is quite long. Explanation of adjustment needed to ensure that comply with IFRS provision. Yours can be very short. You can write something like adjustments required to present IFRS compliant financial position for Mansa Cocos Limited. As simple as that. No greeting, no special, because those that you are an accountant, that's not what they are even expecting from you. The cocoa is the content, but you have to do it around the structure of an internal memo. You build your points, point by point, you've done all of that. At the end, that's the structure I want to show you. What is your conclusion regards financial controller? That's all. Okay, so let's go into the nitty-gritty of what needs to be done now. So let me ask, do I need to do screenshots? Do we have the question maybe printed so that I don't have to do back and forth with whether you have the question or not? I've already even started writing on itself. I messed it up a bit. Do we have the questions? Can I move ahead and just probably just create a new sheet for us? Stop this sharing and share notes. Are we okay with that? Can I use the chat box if we are too shy to speak?
Yes, sir.
So I can go ahead. All right. In terms of adjustments, let's take it one by each. It's going to be a lot. Okay. Now let's go back to the question. The question says, first additional information we got. We're told on 1st January 2023, Mansa Cocoa acquired specialist equipment from the United States of America, USA, for $150 million. Now, payment for the equipment was made on 31st March 2023. Right. Okay. The first thing is this: the date we bought. Now, if you're doing IFRS, IS 21 says the spot rate. Spot rate as of which date? The date we acquired, January 1, 2023. Now let's go to the question further down. Go to where you have the rates. January 1st, 2023 is 2.5. All right. Okay. $2.5 equals 1 GMD. All right.
Yes.
Okay. So if the cost of the PPE is 150 million USD, now I have told you, am I supposed to divide? Am I supposed to multiply? I don't know if you find this simple rule simple, but I find it very simple. And that's what I've shared with you. If I need more currency units to convert to one currency unit of another country, then it means that one that they are showing you as one is the more powerful currency. So when you're converting to that currency, you will divide, not multiply. So from what you are seeing here, this may not be the reality, don't mind ICAN. ICAN is saying in this question that Gambian Maladi, or whatever, God forgive me, is a stronger currency than USD. Do you understand now? Because you need 2.5 units of dollars
to get one
for you to get 1 unit of the Gambia Maladi. All right.
Yes.
So it means I'm going to divide. I'm going to divide by what? I'll convert this by dividing by 2.5. Now that equals how much in Gambia Maladi? 150 divided by 2.5 will equal 60 million. Okay. Now.
Yes, 60.
60 million. Now, under IFRS, what I will do on this day is I'll say debit. I would have said, because they have already done the accounting anyway, is the changes I want to look at. But I'm coming back to that. Well, let's use a fresh mind now. I would have said PP 60 million. All right. Then I'll credit my payable 60 million. This is what they should have done. But what have they done instead? What they did instead was to use the opening rate, that is the close rate of the previous year. And that opening rate was $3 to 1 GMD. That was why they have 50. Because if you do 150 divided by 3, you get 50. Is that 50 that they have in their book? All right. Now, when you eventually pay, you're going to pay, the payment was made March 31st, 2023. Now, the rate as of this day was 2.4. All right. So when they are going to pay, they would have done divided by 2.4. Now, 150 divided by 2.4 as amounts to 62.5. So the real exchange loss here, there's an exchange loss, all right? The exchange loss that they had recorded according to the question, if you go back there, you'll see that they said that, let me go back to note 1. They said the last note there, the last paragraph, they said the sum of GMD 12.5 million has been debited to retained earnings. This is in respect, they debited to retained earnings, meaning that they recognize the loss, but this loss is more than required. So we're going to need to make an adjustment to the retained earnings. Now, exchange loss should be
Sir, please, you sound like you're far away from your mic.
How about now? Is it better now?
Yes, it is. Thank you.
All right, thank you. Now, 62.5 minus 60, and now equals 2.5 million. But what did they recognize? They recognized 12.5. Okay, we're going to look into that as well. Another thing that they must have done, their annual depreciation, they said it was 5. Okay, but let's look at what we're going to do here. The cost of this asset is 60 million. They said it has a useful life of 10 years, meaning that my annual depreciation should be about 6 million. All right. But mind you, the day we bought this asset was January 1st, 2023. And the closing year or the closing date, the close date or the accounting closing date of Mansa Conco is September 30th, meaning that we'll count 9 months. The whole of January, February, March, April, May, June, July, August, September. If you counted fingers with me, you would have counted 9 months, okay? So this would be 9 over 12. So if you do this, it's more or less saying 6 multiplied by 9 divided by 12. That gives you 4.5 million. So meaning that they are also charging too much depreciation that they treat. What they have charged as depreciation, according to that requirement or that additional note, note 1, if you look at, I think the third additional information, they said full year's depreciation of 5 million was charged. So they even do, maybe according to their gap, you don't do, what is it called? You don't do apportionment. They don't prorate. Thank you. So they don't prorate, they just charge the full. Now, some companies will do that, but IFRS didn't say anything like that. Do you understand? IFRS didn't say you should not prorate. Month on month, your system should calculate your depreciation, or even if it is manually calculated, you should have done it on a monthly basis. So if you have for 9 months, what you may say is if you bought the asset in between the months, you can decide to count the whole of the month. So you don't have to do days, but you can do months. All right. Okay. So that's 4.5. It means that there's an excess depreciation. Excess depreciation, 5 million GMD. Please don't be like me. Don't be like me in this instance. Please, that GMD, you are not used to it. I know. Just like me. But write it so that it is obvious that you are referring to money. All right. Now, it is going to be 5 minus 4.5 million, and that's GMD 0.5 million. So what do we do here? How do we treat? How do we correct what they have done? All right. Here they did 50. I'm going to do additional 10. How do I do that? Okay. I don't know if we can do this. Do all our workings on one side, put the double entries on one side. This space is too small for me. But let me put it like this, okay? I'll say debit PP, all right? As of this day, we'll debit 10 million, we'll credit payable, additional 10 million. I want to believe you understand where I'm getting this from. This is the additional 10 million that they should have recognized on 1st January 2023. All right. Now, on March 31st, 2023.
Excuse me, sir, please, before you continue. Okay, I just want to be sure that I'm following. From the question on the first, let me see, on the 1st of January, they organized 50 million GMD instead of 60.
Yes.
Okay, now, so this additional 10.
Yes.
To make it okay.
Let me write it there so that we get it. Additional 10 million GMD as cost of PP. All right. Now, when you've done that, next thing we have here is March 31st, 2023. On March 31st, 2023, when they had paid 62.5 million. Now, what they initially did was they must have debited retained earnings with 12.5 million. In fact, that's what they said they did. They debited retained earnings with 12.5 million. To recognize the gap, they paid 62.5, but what they have recorded is 15 million. So when they did 15 million, they would have said debit PPE 50 million, credit payable 50 million, 50 million. Now that they have paid, what they did was to debit payables 50 million, then debit retained earnings, the remaining 12.5 million. All right, now credit bank 62.5 million. Now to undo this, bank 62.5 million is correct, no problem with that. All right. What I will change is, remember that my payable has increased by 10 million, meaning that what I have in my payables now is 60 million. All right. So what I should do is to first of all find a way to undo that retained earnings or reduce that retained earnings to 2.5 million. How do I do that? I can credit it by 10 million. Abi? So I can say credit retained earnings. How much? 10 million. And then they must have debited 50 million to payable. Abi? But we have 60 million there now. This additional 10 million is there now. So I can say debit payables, so that nothing is left in my payables, 10 million. And then I'll say being reversal of excess exchange loss. Is this understood as well? Is this understood?
Not really, sir.
What did you say?
Okay. The exchange loss
Yes.
ought to be 2.5.
Yes.
But they recognize 12.5.
Yes.
Okay. So the excess is 10 million.
Yes, that excess that is 10 million, they debited 12.5 to retained earnings. So when you credit retained earnings by 10 million, what you have done is you have reduced that loss to 2.5.
Okay.
Also, your payables, I said you want to clear out, in this type of instance, you want to clear out that payable that you initially recognized. Payable means you still have money outstanding. But now that you have paid, what do? You debit the amount that you recognized as payable, right? Now, what we have done initially was to increase the payable by 10 million as of January 1st, 2023. And when you come to as of March 31st, 2023, you will take out all of the payable. Now, they must have debited 50 million. The remaining 10 million is what I'm taking out now. Do you understand? Because I put the additional 10 million there in the first instance. Now that they have paid, I must recognize that that 10 million will also go out to the 50 million. Right. Okay. So the next thing will be the excess depreciation that they recognized. The excess depreciation. Now, for the excess depreciation, what do? I can say credit POL, or I can say credit retained earnings if I like. POL depreciation. I'm going to credit it by 0.5 million, and I'm going to debit the asset, PPE. You have further reduced the PPE more than you should have. So the carrying amount of PPE will increase by 0.5 million GMD. So I will say reversal. I can call this reversal of excess depreciation. Is this clear? That is what I'm doing there. Is this clear now? Let's people, is it clear? Let's use the chat box in case we are shy. Is it clear? Are people going to go and cook for Sarini? Is it Sari or Ishino?
No, we are here.
The people go and cook iftar. Is this clear? This is all the necessary adjustments you need to do. Yeah. Correct excess depreciation.
Reversal of depreciation. Yeah, it is clear. I understand. I don't know for that. So
okay. Maybe I should call him. Praise Koyejo. Is it clear? I think Priscilla is another person that follows me. If she says it's clear, fine.
Call the person and ask now. Excuse me.
Mr. let me hear from Priscilla.
Okay, please.
It's not completely clear, sir.
Oh, which part? Which part? Let's look at what part is not.
Sorry, sir. Why didn't we use 62.5 as the cost of the assets?
Oh, very good. Very, very good question.
I think this part that got me confused as well.
That part got you confused as well?
Yes, sir.
Okay, good. All right. Now, we are not going to use 62 because as of the day the asset was acquired, the asset was, the spot rate was $2.5 to 1 GMD. Now, what IAS 21 said is that if it is a non-monetary item, what is monetary item? When we're doing it, I made mention of it. If by transaction now, if over that asset, I am still expecting to receive money or to pay one money, then I will call it a monetary item. For instance, if it was a payable, if I have a payable as of, okay, now look at the payable, for instance. If we did not pay this money on March 31st, we did not pay it as of September 30th, what I will do is to recognize the amount we have not paid using the closing rate. That's a monetary item. But the PPE, we have bought the PPE already. We are going to record PPE by standard is recorded at its historical cost. Do you understand what I'm saying? Except you are doing revaluation. And the revaluation there is not a revaluation of exchange, foreign exchange. It is a revaluation of the intrinsic value of the asset itself. I think I mentioned that case when I was teaching this class, and I said that I worked in a place before. I discovered that the system, whenever it is doing system revaluation, it will do the revaluation of assets that were purchased in foreign currency as well. And I raised it. I said this is wrong. In accordance with IAS 21, PPE is not to be revalued using the spot and the closing rate every period. No. You're not going to do that. You will keep the PPE at its historical cost. The only time it will change is if there is, number one, you are using revaluation method. If you are using revaluation method, okay, you're going to use the new revalued amount as the carrying cost of your PPE, less any depreciation. Number two is if there is an impairment, then we expect it to. So you see, if it is not the intrinsic value of the PPE that has changed, or you did some review and you discover that there is a change in the useful, another instance, maybe there is a change in the useful life of the asset, and therefore you now need to, going forward, you started changing, you changed the depreciation, all those things. Those are intrinsic value of the asset. That's the only thing. It will not be the foreign exchange also to now go and say, oh, it was 60 million. Now, March 31st, we are now paid. No. The only thing that will change is if your payable remains outstanding. The same thing with receivable. If we sold an item, what if we sold an item of inventory? The fact that exchange rate is changing does not mean, oh, we'll say what is. What we're going to do is to say the receivable that we have recognized, what we are expecting to receive, that one can change as a result of changes in foreign exchange rates. That's a monetary item. That's a monetary. That's it. Our bank balances in foreign currency can also change. That's a monetary item as well. But PP is not a monetary item in line with IAS 21. So we don't do that change. Is it clear, Priscilla and Pascal?
Okay, sir, thank you. It was understood. Please, again, apologies. I want to ask, like, items in the SOPL, they are recognized as opening rates.
You are not alone. So it's not only, I think it has to do with the lecturers, maybe network or something. It's not even on the call at the moment, so waiting for him.
All right,
Hello?
thank you.
Oh, he's back.
I'm back now. Sorry, guys.
Welcome back, sir.
Okay, so who was I speaking with? Somebody was asking a question, something like that, about PPE.
It was Pascal.
Okay, Pascal, please come back, please. Pascal,
Yeah,
is
I'm
this still
here,
here?
sir. I'm here.
You were asking a question about POL.
I'm asking what weight do we use to measure items in SOPL and SOFP and changes in equity?
Okay, don't get it wrong. There are two different things that IAS 21 covers. You can go back to that note. Two things. Number one, there will be transactions in foreign currency. That's what we have here. If you notice, this IMPP was bought from USA, right? Is for Masa Konko, it is a transaction in foreign currency. Now, what you are asking me is relating to foreign operations. When you want to consolidate the books of a foreign operation or a foreign subsidiary into the group account in your own presentation currency. So we covered that already. What we said was that P&L items, you will use average rate. SOPL, you're going to use the closing rate, all right? But when it comes to equity, you're going to use the historical rate. And there you're going to analyze those exchange differences that we made mention of when we were looking at it. It's still the same thing. That one has not changed. It is just for you to be able to understand the difference in these two things. Now, when you have a transaction in foreign currency, as of the day of that transaction, you use the spot rate to recognize that transaction. Now, whether you are going to keep it at that historical rate or you are going to revalue using the new rate as rate changes is dependent on, is it a monetary item or is it a non-monetary item? Now, if there is an outstanding payment you ought to pay, it means you have a liability in foreign currency. It makes sense for you to continue, as long as that liability is outstanding, you will continue to revalue what you owe. Abi, I'll say, oh, what I owe in dollars is $50,000. As at the end of 2024, let's say, for instance, that was equivalent to, let's say, 20 million naira. Now, if I'm going to report today, I will tell you, oh, $50,000 cannot be the same rate as of last year. I will tell you what it is equivalent in naira as of today. Why am I doing that? Because it's an outstanding payment that I owe, and that is the account I'm using to recognize what I owe. Now, that's different from PPE. PPE is a non-monetary item. I have bought that PPE and to recognize it at the historical cost. So, except the intrinsic value of that PPE increases or whatsoever, those are the things that will make me change the value. I have said revaluation method. And revaluation method does not speak anything to foreign exchange at all. If you are doing revaluation method, it will be because, oh, the actual value of the PPE has increased. That's why I'm doing that increment. Or it has decreased and you are now recognizing it. Or there's an impairment and now you're now recognizing that impairment. Do you understand what I'm saying now? If there is a receivable as well, your receivables account is also a monetary item. We are expecting to receive $50,000. The equivalent is this as of last year. Well, as of today, oh, maybe it has decreased or it has increased. If I have an investment in let's say, for instance, we invested in Euro bonds, I'm going to be keeping track record of the coupons that are receivable. If I am recognizing it in naira, the amount did not change in dollar, but in naira it is going to be changing. So therefore, I will need to take cognizance of those changes as I am reporting. However, what will not change? Something that is not likely going to change is something like PPE. I bought a PPE, I bought car, I bought all those. Those will not change. It will remain the same. Do you understand now? Is it clear now?
Yes, sir. Yes, sir. Thank you, sir.
You're welcome. All right, let's move on to the next one. The next one here is with regards to impairments. All right, but I've also seen that intangible asset. Okay, we're looking at IAS 16 there. Okay, we're told that Massa Cocoa Limited bought a warehouse October 1, 2016. We've done some calculation here already. I'll just go back to them. All right. Sorry. Okay. Bought the warehouse October 1, 2016 for 180 million Gambia Maladi. Now the warehouse is being depreciated over 20 years with no residual value, right? On October 1, 2022, due to a rise in property prices, the warehouse was revalued to 210 million and the revaluation surplus of 84 million Gambia Maladi was recognized. We've done the workings of how they got 84 million. But let me quickly do that. Now, how did they get 84 million? The property is worth 180 million. Cost is 180 million. Now, this was as of October 1, 2016. All right. Now, useful life. Useful life is 20 years. Annual depreciation is equals to 180. They said there's no residual value. Divided by 20. That means you have 9 million Gambia Maladi annually, every year. All right. So total depreciation as of October 1, 2022. If you count between these years, you have 6 years. Abi, you have September 2017, September 2018, 19, 20, 21, 22. That's 6 years. So that's 9 times 6 years. All the depreciation we have is 54 million. All right. Therefore, the carrying amount will equals 180 million minus 54, and that equals 126 Gambia Maladi. All right. Now, those 126 million, that's the current amount as of 2022. If they are now telling us that the revalued amount is equal to 210 million, all right? The revaluation gain will be this 210 million minus the carrying amount of 126. This was how they got 84 million. Now, if you understand all of this up to this point, you do not have a problem. First of all, first thing to do is to say, we'll credit this PPE with 84 million naira, 84 million Gambia Maladi. Apologies. Then revaluation reserve. We'll credit that. So we say being revaluation gain of the property. Revaluation gain of the property, right? Now, I said something the other time. I said, according to IAS 16, you have the election or the right to transfer any excess depreciation. And what is the excess depreciation? I said that excess depreciation is this. The current depreciation going forward, the current depreciation is now 210 million. The new revalued amount divided by how many years are left? How many useful life?
14.
We said you're going to get 15 million. So the excess depreciation will be the new annual depreciation, 15 million, minus the initial annual depreciation, making what? 6 million. Now, IAS 16 allows you to make this transfer between the revaluation reserve and the retained earnings. Meaning I can say debit revaluation reserve, 6 million, credit retained earnings, 6 million. So this was what I was taking my time to explain the other time. Is this clear now? Is it clear? Please give me a moment. Give me a moment. All right, so is it clear to every one of us? Do we get it clearly now? Can I move on? Nobody's answering. Should I move on?
Sorry, so please explain the entry for excess depreciation again.
Okay, I said that IAS 16. Whatever you are doing, maybe what I would advise us to do is, I know you remember IAS 16. I know you know IAS 16, especially based on the cost method. Is very straightforward. But what you must not forget inside IAS 16 again is this revaluation method. I said it is standard. It is not Abed that said it. It is standard that excess depreciation is the difference between the initial depreciation that you recognize and the new depreciation that you're going to recognize going forward. All right. That excess depreciation, you are allowed to make a transfer between revaluation reserve and retained earnings, meaning that excess depreciation, I am going to take it out from revaluation reserve and I'll plug it into my what is it called now? I'll plug it into my retained earnings. Do you understand now? I'll plug it into my retained earnings. So that's 6 million difference. That's what I've just simply done there.
All right, thanks, sir.
Thank you. Thank you. All right. Now, we do not have a problem with how they have treated the impairment loss. What do I mean by we don't have a problem with that? What they have simply done is to say, all right, the new value of the asset is now 60 million. All right. The last time we revalued it, it was 210 million. This is a difference of 150 million. All right. Now, we have recognized gains. There's a 6 million in retained earnings. There's an 84 million. I'm coming. There's an 84 million in revaluation reserve. That 90 million is what they are first of all charged. If you look at it, they said 90 million was made to profit or loss to reflect the difference between the carrying amount of the warehouse of GMD 150 million before September 30, 2023, and the new value of GMD 60 million. So we don't have a problem with this one. What we have a problem with is something critical here where they said no transfers are made between the Gambia gap has a problem with that. IFRS does not have a problem with that, and that's just what we've done. So in my internal memo, I will have to make it clear. See, this point here, me as an examiner, that's Abiodun as the examiner. I will not punish you if you did not do this because it is elective. You can decide to do it, you can decide not to do it this way. I don't have a problem with it. But what is the indication here is that they specifically said that under Gambia gap is not allowed. So you have to make that point that it is something that is allowable under IFRS. That's all. All right. So let's move on to the next one. Financial instrument. Okay. Said on April 1st, 2023, Mansa Cocoa Limited bought 5 million shares in a local quoted company for 7.7 Gambia Maladi. Sorry. And I said this represents 3%. Okay, we've discussed this already. I said this is for accretion of wealth. Anything less than 20%. Anything that does not give you control, it also does not give you, it doesn't give you control. It also does not give you significant influence. If it doesn't give you control, and it also does not give you significant influence, most likely you have only bought it for accretion of wealth. You would use IFRS 9. Yeah, all right. And we said, since the intention of the company is to hold the shares until 31st December 2023 and then sell them for a profit, it means that the business model, the business model and how they intend to make anything off this financial instrument is by selling it for gains. All right. So we'll use fair value through POL. All right. That's not a problem. So let's quickly look at it now. As of September 30, their reporting date, it is now worth 12.5 Gambia Maladi per share. All right. So what we will do, what we will do here is to say, as of when we bought these shares, we have 5 million of it. Multiply that sorry, why is this thing not moving? Okay, let me write it here. All right, 5 million multiplied by 7.7. 5 million multiplied by 7.7. What do you get? 5 times 7.7. That's 38.5. All right. So this is equals 38.5 million. All right. But as of reporting date, it's now 12 point what?
12.5 per share.
12.5. 12.5 times 12.5 times 5 million. What do we get?
62.5.
That's 62.5. So they must have recorded in their books, they would have recorded 38.5 million. That's not a problem. That's in line. It's very much in line, no problem. Because they said they put it at historical costs. Where we have a problem is retaining it at that cost. You cannot retain it at that cost. So what you should do in line with IFRS 9 is that you should now record it at this new value. My system is messing up. Okay. God. Permit me to. Oh God. Let me stop sharing and reshare. Okay, good. Now this amounts to 62.5 million. So we need to restate this value to be 62.5. The difference between them, 62.5 million and 38.5 million, is 24 million. All right. So I should recognize debits. What's it called now? Financial assets. You can put in bracket equity, 24 million. And then I credit P&L, 24 million. That is all about that. This is the most easy and straightforward additional information you could possibly get. Okay, let's move on. Provisions. We're told on October 1st, 2022, Mansa Cocoa Limited signed an agreement with the Gambian government who said this exclusive right should be capitalized. They got it for 42.5 million, right? Now, where we may have an issue is where they have said that 40% probability that the eventual cost of replacement of the damaged t-shirt would be 75 million and a 60% probability of the cost of replacement being 50 million. I said, sharp guy, some things they won't tell you. I remember one paper I did then, I think it was PM. And I used average numbers. And the reason I used average numbers was simple. They gave weekly figures. And they gave I think they gave daily figures Monday to Friday. And I know I need a number that will represent for each week. So it's simple. I needed to do average. Starting things like that, you were not taught in class. You probably will never be taught in class. You may never. I can bet that it's possible that your lecturer never mentioned it. But on the day of the exam, you meet something like that, you know that you should think towards that direction. There are some things that are just like that. So when they said 40% and they said 60%, it should become something on me that what we are supposed to do is to calculate the expected weighted cost of replacement. How do you do that? Whenever you have done it in PM before, expected value, what you do is to say 40%, the eventuality, 60% of 50 million. 40% of 75 is how much? I think 30. 60% of 50 is also 30. meaning that this is what we are going to recognize to be the expected value of the cost of replacement. This is what we are going to recognize. But we will not recognize all of 60. Why? Because this is a future value. This is what we expect to pay at the end of the 60th year. So what do? We bring it back to present value. And what is the formula for present value? It is future value, open bracket, 1 plus r raised to power minus n. All right. N year is the 20th year. That one is easy to get. They gave us, if you look at the question, if you look at that part, the last paragraph says Mansa Conco Limited has a pre-tax discount rate of 8%. Now, the replacement cost will be allowed for tax purposes when paid. The relevant income tax rate is expected to remain at 20%. All right. You don't have a problem with 20%. They have told you it is a pre-tax discount rate. Okay, that's the rate I'm going to use. This is 8.
From this place.
Somebody has their mic unmuted. Please. Just mute. Whoever that is, please just help us by muting. All right. Okay, future value is 60 million. So this is what we should do. It should be 60 million, open bracket, 1.08 raised to power of minus 20. Now, when you press this on your calculator, what do you get?
Approximately.
What I have is 12.87 million. All right. So what do you do?
You can approximate.
You can, if you want to, make it known to your examiner. It's not a problem. Cost of rights, which they must have debited with 42.5 million. I said that I think even in this is also part of IAS 16 itself. Whether it's IAS 16, whether it's IAS 38, pay attention to this. If there is a cost that you will have to incur, for instance, restoration of sites. I don't know if you were taught this. Restoration of sites under IAS 16.
Is it 16?
You will have to provision for it and add it as part of the cost of the asset. So it's the same thing that is applicable to IAS 38 now. You're going to have to incur a cost at the end of the useful life of this right. That cost, you have to provision for it, then do the, the present value, add that present value to the cost of the asset. And then on a yearly basis, you will do unwinding cost. Unwinding cost meaning that you're going to charge that as your finance cost. What it means is this. Let's look at it together. Present value of this 60 million in the 20th year. The present value is 12.87 million. Now I'll say cost of rights, 12.87 million. And then I'm going to credit provisions. I'll credit provisions with 12.87 million. All right. Now, that's that. Now I said this would have been done as of when? This would have been done as of when? When did they get the right? October 1st, 2022. Right. That would have been done since, it should have been done since that time. So by 2023, 30th October 2023, you would have counted 1 year. So the finance cost or the unwinding for that 1 year, how do you do it? It's simple. 8% of the present value, the discount multiplied by the present value. How much do you get here? You get about, let's say about 103 million. What do you do to that? You're going to debit it to your P&L. That's your finance cost, right? And you're going to credit provision. Now, what is the meaning of this? I think I've mentioned it in this class before. The meaning of this is just that you have started from 12.87. Year on year, you will increase your provisions until the 20th year. By that time, all of the summation of what you have credited to your provision will equal 60 million. So by that date, the provisions will now be up to 60 million. All right. Okay. Then don't forget that you are also to amortize this intangible assets. So what do we do to amortize? To amortize, what we will do is to say, now, what is the cost of this asset? This intangible asset. The cost is 42.5 plus this provision we have made, present value, divided by how many years? 20 years. They said the useful life is 20 years. So that gives us how much? If you add it together, first of all, I don't know what's wrong with my system. If you add it together, what do you get?
55.37.
55.37. Now divide that by 20.
2.77.
Yeah, 2.77. So that 2.77, you treat it like your depreciation, the way you would normally treat depreciation. Of course, it's going to reduce the carrying amount of your intangible asset, the cost of rights. So I'm just simply going to debit P&L here and credit cost of rights, my intangible asset. Okay. So that is that there. Your total provisions is this plus this. If you add the two together, you should get about 13.9 million. And your new carrying amount will be that, how much did you call it? 56 point, what did you call it again? Is it 55 point something? Minus
Please, can you do that again, please? You said the new cost of rights.
the new cost of rights. Okay, let me do it here. I don't know why all of a sudden I can't control this. Taskbar is giving me something. Okay, I'll come back to that later. So we have 42.5. Can you see where I'm writing? Top right. We have 12.87 million. All right. And now we are going to deduct 2.77. So what do you have?
$52.6.
So that 52.6 million is going to be the new carrying amount. All right.
Okay.
Now I'm going to, oh God, it's so hard to stop. Okay. Let me go back to the solution because there's something I won't be doing. This one, I want to quickly round up because of Àwọn aláwẹ̀, those of us that are fasting, that want to break their fast. Maybe that's why the number is even low, Seth. Who knows? Okay, you have the material. Now, if you go to their solution, I'm sure we have 99.9% the same thing. I've compared what I had done earlier with what they did. And maybe one or two places, we did one or two things differently, but it's the same thing at the end of the day. So where I want to go now is the consolidation. The issue with this question is this. Can everybody hear me?
Yes.
Water hit the face of my screen. It's not making me to be able to control some icons. It's giving me issues. Okay, if you have the solution with you, just go to the solution. Don't worry. Let me use my phone. Just go to the solution, don't worry. I want to show you something there. You see, we do not have a problem with this one. What I have a problem with is how I will possibly show you the numbers that we are to use. So I will owe you two things. Last week I said I will put those numbers we used together to form the solution, even though we have done everything, just to show you the balance sheet, all right? The consolidated financial position. This one, let me show you what they did for the B part, the consolidation. You know, you are not doing consolidation. All you want to do is to just give us the numbers. Now, you have made adjustments. Those adjustments, if you go to the solution, I just showed you the revised statement of financial position suitable for consolidation. That's on page 21. Are we there? On page 21. Now, go to page 22, you will see their workings. Now, the question did not tell you, it's not for you to do consolidation. So what did they use as the exchange rate? I'm going to come back to the revised numbers. Let me start with the exchange rate. They use five Gambia Maladi to Naira. Now let's go back to we're giving that figure. They use the closing rate. And they use it all across. So somebody will ask, why did they use it for equity? This equity, don't forget, is not yet your consolidation. Number one. Number two is that you were not given the historical rates.
Yeah, reply.
What did you say? You were not given the historical rate for the cost of acquisition of hello, somebody has their mic on mute. Can you please help us mute?
Praise, unmute your mic, please.
Hey, Jesus. Okay. So now, what I'm saying is this. Number one, they didn't give us the historical rate. So there's no way they could have done this solution using the historical rate at which, what is it called? Calabar PLC bought Mansa Konko. Number one. Number two is that since they did not give you the closing rate, the close rate is what you have used for other items of SOFP. So you can use it all through. And that is what the examiner has done. That one is straightforward. What it may not be so straightforward is you have done all the workings. How do you know the revised numbers for each of those lines is what I want to show you. I'll do, maybe it will be handwritten. You have to forgive me. If I say I want to do it typed, it will take me some time. I really do not have that time. So what I will do is take a foolscap sheet. Is it foolscap sheet they call it? Or A4 paper rather. And then I would write it with fine handwriting, the workings, what they did to get those revised numbers, so that you can make sense of that solution. Do you understand now? So I will not be doing that one. All they have done is you use the revised number line by line. The PPE we have done, all those adjustments, 10 million here, 5 million, 0.5 million here. It is the addition of that with the numbers that were already there. That's how they got those revised numbers. And they divided everything by 5 GMD to get the equivalent in Naira. That was all that was done. Is it clear now? Is it clear?
Yeah, I think when we go over it again, it will be clearer.
Okay. All right. Unfortunately, I don't know. I've really lost control. So I will have to end it here. I've lost control of my screen. I have to restart my system. I can't even end the meeting. All right. Okay. So our next class, we're just going to do cash flow. In our next class, once we are done with cash flow, I'm going to go to IAS 33. IAS 33, we'll do IAS 33. Once we're done with IAS 33, we'll do IAS 37. After IAS 37, now for each of those standards, what I will do is we are going to have practice questions for the standards. We'll solve maybe one or two after explanation. No, one or two, okay. Maybe like two in the class, because that one is straightforward. I also want to teach you the standards. It's theoretical. If I don't do questions, you may not understand. So then you now get your own question that you're supposed to go and solve on your own for each of those standards. That's what we do. So the standards I have left with you is we're going to do IAS 7 cash flow, but it's going to be the group one we'll do together. After that, we'll have IAS 33. After IAS 33, we're going to have IAS 37, provisions, contingent liabilities, and contingent assets. Then I'll go to IAS 12. And lastly, IAS 10, which is the shortest of all those standards. We'll look at it together. And then after we're done, we can, as a bonus, look at another question that has maybe a myriad of standards together again. Thank you very much. Thank you. That's where we're going to end it for today. God bless you. I'll just have to restart my system now. Thank you.
Thank you. Bye.
Thank you, sir.